You're 4 minutes away from Jeff Olin, Vision Capital. But first, my shocking stat of the week. Thanks to George Orwell for this one, and it explains why our politicians ignore subjects like the massive shift in the population, the aging population, the financial implications. It explains why supporters sit there and don't admit to or acknowledge the massive changes that are happening through technology and the job challenges that'll be in specific segments of the economy. It explains why we ignore what's been going on in Europe and that many people wanting to adopt many of the same policies that have produced a dramatic and profound economic malaise there. George Orwell. All political thinking for years past has been vitiated the same way. People can foresee the future only when it coincides with their own wishes, and the most grossly obvious facts can be ignored when they're unwelcome. All political thinking for years has been vitiated the same way. People can foresee the future only when it coincides with their own wishes, and the most grossly obvious facts can be ignored when they are unwelcome. To wit, facts like the aging population, technological job substitution, the fallacy or the folly of failed economic policies, and the massive government intervention model. It's all on display. We just choose to ignore it. I'm very pleased to welcome back to the show Jeff Olin, Vision Capital. Let me just tell you a little story about Vision Capital, as I was doing the review of exactly how their performance has been since their inception, going back, I'm trying to think how many years ago. It was a number of years. I've got it right here on my screen. But I think when you look at from 2008, I think it was July, it was the date when they formed. And I would look at the total returns, and we've had, pretty darn good stock market lately. So you look at the S&P and the TSX, their REIT index, for example. Well, it's up 114%, not bad. Vision Capital up 241% up to the end of February. TSE Composite, it's only up 42%. Vision Capital's up 241% since that time. It's 2008 through to February of this year. Jeff Olin is the co-founder of Vision Capital. Jeff, can we just say in a quick nutshell what you do? I always sort of describe to people that these guys have found a way to buy real estate, be in the real estate sector. They play it both to go up and to go down, but they do it in a way that's interesting because if they want to buy something, they can get it at a discount.
Right. We focus on real estate through buying securities in the stock market. So we buy equities and debt, and as you indicated, we can be short, we can be long or short. So the reason we do what we do is we have the opportunity selectively to buy real estate cheaper in the stock market than the property market by focusing on the underlying net asset value, what's the real estate worth in the property market, and then comparing it to the trading price in the stock market. And the other side, if valuations are excessive or fundamentals are negative, we can be short, where you can't short an office building or an apartment building or a shopping center. Yeah,
the other thing that I'd like you just to explain to our audience again is that you don't get, you're not overly focused, for example, on total return and high yield. And in fact, I know I've read things by you that you say that actually could be a red flag.
Yeah, just to clarify, we are focused on total return. We're not focused
total return,
on yield. So, yield, as I might have mentioned before to you, I don't know any business in any industry where anybody looked at how much cash flow somebody was going to pay you in terms of a dividend as opposed to how much that business was earning and earning tomorrow, not yesterday. And so yield can be a red flag. In fact, the Ontario Securities Commission recently stimulated an industry group in the real estate sector called RealPAC to improve their disclosure rules to investors because there's a lot of problems hidden by paying yield, and investors generally, retail investors particularly, are seduced by yield, whereas you got one number of the things that we invest in have low or no dividends, and this is real estate. It's relatively easy to value, and it's the underlying value of the properties that matters, not how much somebody's paying you as a dividend and often overpaying you to seduce you to buy their stock.
The other thing that when I first started following you, and it was about 8-9 years ago, the thing that I liked was that you could be short real estate because I was certainly in the view that we were going to have some real cyclical problems there. And I'm just thinking, when I think of that, I think how well you've done in the Calgary commercial market, playing it to actually go down.
Yeah, I mean, exactly. I mean, we looked out 2013 and we saw too many office buildings being built, so too much supply in the context of a secular reduction in demand. We don't need as much office space. There's no more law libraries. You know, Deloitte & Touche just built new buildings in Toronto, Montreal, no offices for partners, no desks. You come in, you empty your briefcase on a table, the next day you got somewhere else. So, you know, when I was building office buildings in the 90s, we built them 250, 300 square feet per employee. Now you're down to about 150. So too much supply, secular reduction in demand. So we've been short office for about 4 years.
And done well with it, though, is what I'm saying.
Done very well, yeah.
Does that extend across the country or across the U.S.? Because you do lots of work in the U.S., which, again, was a check mark for us on Money Talks because I wanted some U.S. dollar exposure. We're still bullish on the U.S. dollar on Money Talks. But can you have pockets, for example? I mean, obviously, you're going to be geographically specific when you're making the investment. But is it just a broad brush there? You're telling me that the Canadian office game has changed.
Great question. I mean, yes, we do focus by property type and geographic region. So every office market in Canada is pretty much overbuilt except the financial core in Toronto. I mean, the core of Toronto is in pretty good shape. The suburbs, not so much. U.S., it's generally more healthy. Downtowns are better than suburbs. We like New York, Manhattan office right now, and that's the advantage of what we do. I mean, if you go back to your Alberta question, we went from being bullish Alberta to bearish in Alberta in 2 weeks when the oil prices and political situation changed. You own a lot of real estate or you own a real estate fund that owns a lot of bricks and mortar, you can't do that. You can't have that liquidity.
Yeah. And so let me go. I'm going to ask a couple of specific ideas from Jeff Olin, co-founder of Vision Capital, in a moment. I just want to give another couple of broad categories that you could maybe comment on for me, Jeff. Let's get to industrial. Industrial's not the same as office commercial. So what's your kind of broad view on industrial?
Yeah, it relates to our bearishness on retail. The pall on retail, the advent of e-commerce, all of the stuff, the headlines you read every day about bankruptcies in retail and challenges in retail are benefiting industrial. E-commerce activity is a boom for industrial logistics space. To give you one soundbite, you need 3 square feet of industrial warehouse space to service an e-commerce retailer relative every 1 square feet you needed to service a bricks and mortar retailer. I mean, the stock keeping units in bricks and mortar, they're kept in the store. In e-commerce, they're kept in the warehouse. Returns, bricks and mortar, done in a store. Returns in e-commerce, done in the warehouse. The warehouse for store, they have pallets. Warehouse for e-commerce has packets. And so there's been a big boon for the Amazons in the world in industrial. We like that space. And you're seeing rent growth for the first time in a decade, for example, in the GTA in industrial space.
How would how would an investor invest in that? See, one of the things I like about Vision Capital is that there's a couple of real estate ideas I had. For example, I'm not a fan of malls, and the same reason Jeff is just talking about there. Look at you hear Sears going down, JCPenney with problems, Macy's with problems. I mean, the list just keeps going on. We've lost Woodward's, we've lost Eaton's. Chronicled that with Michael Levy many times over the years. So I don't like malls. Well, I try to figure out how do I play that, though. Well, that's what I liked about the ability of Vision Capital.
So industrial, we have, in Toronto, not in Toronto, in Canada, primarily focused in BC and Ontario. Pure Industrial, read AAR, is a great name. In the U.S., or it's not U.S., it's global, we have Prologis, PLD, in the New York Stock Exchange. They're the largest $30 billion logistics industrial company in the world. So those are 2 quality names that your investors could look at for exposure to the industrial logistics space.
Very quickly, can I come back on retirement residences? I just talked about healthcare and the aging population at the outset of the show, so that's why I'm thinking of that.
Yeah, absolutely. I mean, this is, it's got a lot of headlines this week, but this ain't news. I mean,
yeah.
Leading edge of the baby boom turned 65 in 2011. We've been on this trend for 20 years. It's going to continue. We like the retirement space in Canada. We're cautious in the U.S. Too much regulatory change, volatility, insurance companies, litigation in the U.S., and too much supply. In Canada, we like Chartwell. We like Sienna. Two quality names, and you're going to see long-term growth there. New development makes sense, and again, you got to watch supply, which we do, but those are two quality names, Chartwell CSH and Sienna SIA, both traded here in Canada.
I'm talking with Jeff Olin. He is co-founder of Vision Capital, which you can find at visioncap.ca, visioncap.ca. I got to take a break. When I come back, I'm going to ask him for a few more picks. I love it when Jeff gives me the lowdown on what's going on in the real estate market throughout North America, both U.S. and Canadian sides of the border. We'll do that when we come back on the Money Talks Network. Jeff Olin is my guest. He is the co-founder of Vision Capital. What a great job they do at Vision Capital in that I love this, they choose. On the stock market, you see asset values that are discounted from if you had to go out and buy it on your own there. But they play the market to go both up and down in different areas. They do it geographically across North America. Jeff, just before the break, you were talking to us about being positive on retirement residences and healthcare in Canada. Can I get you to give some other picks at this point?
Sure, we continue to be constructive on apartments on both sides of the border. Similar to seniors, you got powerful secular demographic trends with the millennials tending to be renters versus buyers, and so we like apartments. Our largest holding is actually a Canadian REIT with all its properties in the U.S., pure multifamily REIT, symbol RUF, trades in Canada, both in Canadian and U.S. dollars, but it's all driven by the U.S. This is a high-quality Class A apartments focused in the Sun Belt. Over 60% of their income is driven by Dallas. They produce more jobs in Dallas in 2015, the whole country of Canada. So we like that name. It's got a nice yield, 5.5%. It's trading around $680 U.S., and we think it's worth $820. So that's a great name in our view. Stable, sleep at night, and managed out of an executive team right there in your hometown in Vancouver.
You know, it's interesting. As I say, I like the idea that you go around North America. You get the currency exposure. That must have done well for your investors, too, by the way, when you're playing some of this stuff. Talk to us about a couple of others.
Sure. The Howard Hughes Corporation. This is a $5 billion New York Stock Exchange listed company. Absolute perfect example of what Vision does. $5 billion New York Stock Exchange, no yield, no dividend. So the REIT mafia in the U.S., the institutions, they don't follow it, they don't own it. Incredibly high quality properties. Bill Ackman, by the way, owns about 30% of this. It's worth, in our view, forget our view, the consensus view that those it's covered is about $170 U.S., trading at $121 U.S. And new CFO, new investor relations, incredible assets, a lot of upside in the Seaport district in Lower Manhattan. They have the Woodlands in Houston, which it's a master plan community. It's really a city, 100,000 people there. So that's a great name. We're short U.S. CMBS debt with exposure to retail and suburban office. So that's our play on the negative retail. GGP, this is the finest malls, so we're not very positive on retail, but these are, think the finest malls in Vancouver and Toronto and translate it to the best in the U.S. It's worth about $33 U.S., trading at $22, and Brookfield owns about a third of it. We think Brookfield may take the opportunity to look at this discount to with some partners take over and privatize that entity. So those are a number of catalysts there that, notwithstanding our generally negative view on retail, we don't think it's going to hit the best malls. And a little speculative play for your listeners. The European situation is improving. There's a very early stage company called European Commercial Real Estate, symbols ERE in Toronto. It's got a nice yield of anticipated about 7%. They've got 2 buildings, but it's sponsored by very high quality people. The CEO of CapREIT, Canada's largest apartment REIT, and some of his colleagues have sponsored this. And so we think it's a high growth, early stage, more speculative. But those that sort of like to play more junior speculative situations, that's one they could look at in contrast to the multi-billion-dollar names I mentioned earlier.
I like, excuse me, because again, I get that it explains what you do at Vision, is you're shorting some of the weak credit of non-U.S. Sort of gateway commercial real estate. I just think that's a great example of, I think, the added strategies that you use to improve the yield within your own fund is, I agree. I mean, there's a real opportunity there. There's going to be some problems, as you say, but at the same time, you turn around and say, not every place is going to have a problem. You know, there are some world-class kind of retail mall properties, and you're sort of exposed there through GGP, as you said.
Yeah, I mean, the underwriting standards in the time frame of 2006, 2007, where all these investment banks were pumping out this CMBS debt because buyers wanted it. So they just left all their underwriting standards at home. So you've got values that are not going to be able to sustain when these mortgages mature this year. I mean, one of the things we like about this trade is we have certainty and realization this year. And it's not like other stocks where we think it's worth 10 and it's trading at 6, and not only do we have to be right, but then you have to figure out how you're going to get from 6 to 10. In this case, we're going to know these loans are getting paid off or they're not, and so we like that situation, and that we're going to have clarity this year.
Only got a minute or so left. Can I just get a quick comment? I'm looking at what's going on in Ontario, with their 16-point plan, and out in British Columbia, we've got various parties in a provincial election right now. And I look at this idea that they want to slow down residential real estate, and I think that it's not such a straightforward kind of view.
No, there's going to be problems here. Again, they might have some success through moral suasion in the single-family residential market. That remains to be seen. The vacancy tax, I like that as a resident, not necessarily economically, but I looked at Vancouver, and, my cousin lives out there, and there's 12 houses in his block, and 8 of them are empty. That's weird. So the opportunity for the local communities to consider that just as a community member is interesting. But what's really going to hurt, what was really dumb in our view, is their approach to rent controls. They put rent controls on post-1991 in condos for the first time. The combination of that and 15% buyer's tax is going to have the opposite result of what they're trying to do. You're going to reduce the supply of condos. You're going to severely reduce the supply of purpose-built residential. It's a boon to the REITs because the REITs don't have post-1991. They're not going to be impacted. And so you're going to see the only way that people can increase rents now is on turnover. So turnover is going to come down, but apartment owners are going to be more selective of who they rent to. Seniors will be hurt. You're going to have more smaller units that turn over more quickly. So it's the wrong thing to do. Rent controls have never worked anywhere. They ain't going to work here, and they'll just lead to more controls and more shortages and higher rents.
Jeff, we've got to leave it there, but I thank you so much. I appreciate you finding time for us on Money Talks. Vision Capital, visioncap.ca. Take a break. Shocking Stack next. Coming up, I got Victor Adair live from the trading desk. We're going to talk a little bit about oil, plus, of course, what's going on elsewhere. But, one of the things that I'm always surprised at doing Money Talks is that my goal is to be correct on these major trends, like demographics, started talking about it 15 years ago, bringing on guests who get it right. And Victor Adair has been telling us for over 6 weeks that he was playing oil to go down along with the Canadian dollar. Joseph Schachter came on, I think it was April 2nd, made it very clear that above $53, $54, $55 price was going to give way on oil and get us down into the range we're in today and lower. I'm going to get more on that from Victor in just a couple of minutes' time. But it's time now for this week's shocking stat of the week. Well, the Republicans got their health care changes through Congress this week, as you probably heard. Predictably, the misinformation from opponents and the gloating from proponents began. I saw how many in the commentariat, including in Canada, decided to chime in. But, come on, just between us girls. Not one commentator in the States and Canada has read the revised act. But, of course, that never stopped anyone. But my shocking stat this week deals with the reality of U.S. medicine that you did not hear about when it comes to policies. Policies that are so heavily influenced by vested interests that it's little wonder why their system's such a mess. Go back to when Obamacare was coming to life. Center for Public Integrity analysis of Senate lobbying disclosure forms showed that more than, are you listening? 1,750 companies and organizations hired 4,525 lobbyists. That was 8 for each member of Congress. They wanted to influence Obamacare. They spent more than $1.2 billion lobbying the government. That was on the heels, by the way, of an American Journal of Medicine report that showed that in the year 2000, healthcare lobbying expenditures totaled $237 million, but they had 1,192 organizations involved. 2016 was what? The umpteenth year in a row when healthcare lobbying was the number one lobby group in terms of dollars and people. They spend $500 million a year now as a starting point. And that does not include, those numbers do not include campaign contributions and other kinds of payoffs. In the first 3 months of this year, the 5 largest publicly traded insurance companies, that's all, just the 5 publicly traded insurance companies spent a combined $6.2 million in just the first 3 months of the year. The top 8 pharmaceutical companies doubled the money they spent lobbying. So here's the question. Do you really think they were lobbying on behalf of the public's interest? Because I'll tell you, the naivety surrounding this issue, commentating on the American experience, is breathtaking. U.S. healthcare is a $4 trillion business. There are massive vested interests involved in making money regardless of how poorly or how well that system serves the majority of Americans. They will fight any change tooth and nail. They're making money right now. So with that said, when President Obama introduced his national health plan, or the Republican introduced their changes this year, do you really think it was a document forged with the public's best interests in mind? Or was it the interest of hospitals, pharmaceutical companies, suppliers, doctors, and indirectly congressmen who get campaign dollars? The answer should be obvious to everyone who's figured out there is no tooth fairy. So yes, you can comment on the politics of it, but make no mistake, this bill is the result of special vested interests. Doesn't matter whether it was the introduction of Obamacare or now the changes to Obamacare. I'll take a break. I'll come back. I got Victor Dare chomping at the bit. I'm going live to the trading desk in just a couple of minutes right here on the Money Talks Network. We sent Ozzie Jurek to Europe last week. He'll join me live from Europe next week, but I gave him the day off today. And I said, well, we got much more to talk about here, though, when it comes to the commodity markets, what's going on in the broad markets. Victor Adair joins me now live from the trading desk. You know, Vic, I've chatted to you over the years and said, you know, what we want to do is get stuff right on this show. You know, I'm proud of the record, whether we're talking about the demographic shift that we just had verified this week. We talk about technological substitution. Very proud that we called the down in the gold market when we did. Our major recommendation on this show, you, Michael Levy, myself, has been to get out of the Canadian dollar into the U.S. dollar. All of that is paid off. And we've got another example this week. And that is, you've been saying to us, our audience, I guess it's for about 6 weeks now, that you are playing the oil market to go down. At that point, it was around $55, $56. Joseph Schachter at the World Outlook Conference sort of said, wait, there's going to be another down leg here. Well, we're certainly seeing that weakness this past week, you know, with oil getting down into that 45 to 46 range, mini bounce on Friday. What do you think of the oil market now?
Well, that's a $64 question, isn't it? And by the way, I do stay very closely in touch with Joseph. It was, I think it was 3 years ago at the World Outlook Conference. Joseph and I really had a good sit down after he'd done his presentation. I was very, very impressed with what he had to say, and he kind of laid out his bearish case at that point in time. And we started trading crude oil from the short side back in 2014 and got a good part of that leg down. Right now, okay, and here's one of my favorite little chestnuts, okay, and that is you have to keep the time frame of your trading in sync with the time frame of your analysis. So, you know, if you're a day trader, you're a day trader. If you're trying to position for a multi-year move, you know, bear that in mind, and you got to put up with a little ups and downs. But you go back here at the very first of this year, we had oil at whatever price it was. We are now down about 24%. That's in WTI crude. We've had this tremendous break here just the past, since early mid-April. I guess we're off 10% at one point this week. And then on Thursday night, Mike, this is how interesting my life is. After dinner, I'm up here looking at the markets on my screens, and I saw crude oil, just like in the course of 15, 20 minutes, fall $2. And it was 8:30 at night, and I thought, what's that all about? You know, North America's closed, Europe hasn't opened yet, Japan is closed for a holiday. Why is this happening? It didn't look like a fat finger, like somebody just made a mistake. It just looked like this relentless selling, and that leads to this. There are rumors in the crude oil market, and you know it's going to be true, it's going to come out, that there has been forced liquidation by people who've had these big, bullish, long positions on crude, where the margin clerks say, you want to keep that, you got to put up more money. They haven't got more money. The margin clerks sell them out. I think that's what we saw Thursday night. I think that is like almost a capitulation in the market, and we could see a little bounce here in crude, over the next week or two. I remain bearish, as Joseph Schachter does. I think we're going to see lower prices, but the market psychology all across these markets. You can get the U.S. stock market with the S&P, for instance, and the NASDAQ at all-time highs. The dollar right now, the U.S. dollar, 6-month lows. There is a lot of things boiling out there, and people are kind of swinging from pillar to post in a number of markets. Crude, very dramatic fall, could have a little bounce here, but I think it's headed lower as we go in the next couple of months.
Let me just give a plug for Joseph, by the way, Victor. I'm glad you brought him up. But SchachterEnergyReport.ca. Schachter is spelled SCHACHTER, EnergyReport.ca. It's a brand new service that Joseph has, and I want to reiterate, he's going to come back on our show. We're trying to get him on, but he said he called this down move, but he also said when you get there, I'll tell you exactly what to do to take advantage on the way up. And so he doesn't think this is a long-term in terms of 2, 3, 4 year bear market. He thought it was going to be a significant correction. Victor, just give me a hint when you do that. Like, as I say, you've come on every week, and I don't know, 6, 7 weeks. You said, look, I'm going to play that oil market to go down. Tell me how you precisely you do that. You take a contract, and the contract basically says over this period of time the market's going to drop.
We'll trade futures and options on the commodities market. And one of the things that we do differently than a lot of speculators that are in that market is we hardly use any leverage. Okay, I remember Jimmy Rogers being on the show years ago saying one of the greatest ways to participate in the commodity market, and back then, we're talking about the beginning bull market in commodities, he said, use the futures and options markets. Just don't use so much leverage. That's what kills people all the time. Mm-hmm. So what we've done with our crude oil positioning, and we've been doing this certainly all of this year since the beginning of the year, is we've been buying puts. Why I like that is if something blows up, there's what they call a geopolitical risk in the Middle East, and all of a sudden the crude oil price jumps $15 or something like that, we're not going to get killed. When we buy a put, the amount of money we pay for the put, that's the maximum we can lose. If prices go down, we get a good return. And it's the whole thing about managing risk. In our latest monthly letter that's up on our website, I gave these two great chestnuts from the boys on the floor back in the old days. One of them was, got a hunch, bet a bunch. And another one was, you can never have enough on when you're right. Yeah, and I took these cliches as being a real sardonic way of pointing out to people you're going to make money from managing risk way more than having some magical crystal ball. So we like to keep the volatility down. The way we've traded crude oil is buying puts, gives us the opportunity to make lots of money, but it also limits our risk in case we're dead wrong.
Okay, I got a couple more questions for you. You got to give me the 1-minute answer. You've been short the Canadian dollar. You've been playing the Canadian dollar. We've been doing that long term in this show and adding to it on a short term basis. Are you still short? Are you still looking for numbers, sort of low 70s, even lower?
Yeah, as our listeners know, I've been bearish on the Canadian dollar for 6-7 years. I've been trading it that way in my savings account where I just switched money into U.S. I got to tell you, there's a very interesting thing just happened here with Canada. I mean, the whole world the last couple of weeks has got bearish Canada, and that shows up in market psychology. I think there's a good chance, and here I'm bearish Canada. I think there's a good chance Canada could have a little bounce. We had quite a bounce on Friday. It's just there's such a large bearish position, reasons to be bearish, but markets have these swings in psychology. When the market gets too bearish, it just doesn't go down anymore, and it'll pop, and the people that are short have to cover. I think we're going to see the Canadian, there's a good chance, I should say. I think there's a good chance we'll see Canada trade below 70 cents this year. But in the very short term here, I think we could have a little bounce. And maybe if you're bearish like me, you look for an opportunity to sell Canada if it has that bounce.
And as you say, regular listeners know I hate the euro.
Yeah.
Doesn't mean every day I do. We've been playing it to go down from 160, then 134, 123, all the way down. Okay, here's the deal, Vic. They're going to have the French election tomorrow. Macron is going to win. That's going to spell good things, because Le Pen wants to get out of the euro, but good things for the EU on the short term. But will that signal sort of a top in this recent move that's seen the euro kind of build momentum? Will that seems to be the reason. Do you think that'll, is that the time to short it actually at that point?
We bought some puts on the euro near the end of the week here, and this is just, as Dennis Gartman would call it, a punt. We just got a little view here. We think the thing has had a heck of a rally over the last couple of months. But here's my thought, really, is that people have been so bearish the euro for so long, and I think we got the thought was it was going to break par with the dollar and go lower and lower and lower, and it just didn't go. So I think we had the last few months we've had people covering in their short positions. It may be that, and I got to say this in quotation marks, but it may be the improving economic and political circumstances in Europe have been hidden because everybody thinks it's just a disaster over there. We've seen the German stock market move to new all-time highs, and I know we've had people talk about the stock market is cheaper in Europe than it is in North America, so we've had money flow over there. Maybe, we're just taking a view here. We've had a rally the past few months. We bought some puts on the euro. If we're just dead wrong, we're going to lose a little bit of money, but if we're right and the euro actually does roll over, we'll make some money there.
Victor Adair, thank you as always. And by a reminder here, you can go to polarfuturesgroup.com, polarfuturesgroup.com. You can get Victor's weekly comment there. And, of course, we appreciate him being with us here on Money Talks. Have a great weekend, Vic.
Thanks, Mike. You too.
I'll take a break. You're going to love. Hey, Victor's going to want this one, too. We're going to take a break, but we're coming back. I've got a goofy and two honorable mentions, and all so well deserved. Stay with us. My thanks to all our guests today, and a reminder that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment. It has no fees attached to it. It's in the tech sector. So if you want more information, go to soleraclub.com. Time now for this week's Goofy, but let's start with a shout-out once again to Alberta Premier Rachel Notley's appointee to the Oil Sands Advisory Panel. Sabora Berman, who endorses BC NDP leader John Horgan's stance to, in his own words, use every tool in our toolbox to stop the twinning of the Kinder Morgan pipeline. Despite the very negative economic consequences for Alberta at a time when the province is already posting $10 billion deficits. I mean, you have to wonder what someone who's an appointee of Premier Notley have to do to be removed. I mean, working against Alberta's interests, and she's an Alberta appointee. But given this is a repeat performance from Ms. Berman last time in Toronto, it's not my Goofy this week. Another honorable mention goes to a former winner, Saint Barack Obama, who this week put out a video on the French election telling voters who to vote for. Of course, his choice is the status quo favorite, Emmanuel Macron. That rivals anything that Donald Trump has done in terms of an inflated sense of his own self-importance. Former President Obama, who now, thanks to term limits in the States, doesn't have to borrow his own words, heal the planet. Well, that's lucky, because now he has time to tell French voters who to vote for. Sure. And while he's at it, he could tell them what adjustments they should make to preparing soufflés. I mean, do you really think the French want to hear from an American, even a former president, who to vote for? Well, obviously, President Obama thinks they do. Now, that's an inflated sense of self that would make Donald Trump feel like he's looking in a mirror. But no, this week's Goofy, I'm going head on right to the Canadian Senate. Ah, yeah, the Canadian Senate. The $103,874,365 upper unelected body resting place for 105 politically connected Canadians. It's like winning the lottery, actually, to become a senator. You get $147,700 for life, and it's increased every year. They share an expense account that's going to be something like $5,149,000 for meal. We'll get more for travel, hospitality, professional services. Maybe professional services like Mike Duffy's fitness trainer. Not enough? Well, no, it isn't. How about $4,485,174 on their medical and dental benefits that cover everything? Oh, you would dream to have this. You'll have to forgive me because I've been forking over a fair chunk of change recently for dental work. So I'm extra happy to be paying for theirs. That brings me to this week's Goofy, the sad, many would say obscene case of 52-year-old Senator Don Meredith, who had an affair with a child, but says he didn't have sex with her until she turned 18. He's under investigation for sexual harassment, bullying of former staff members. Many have come forward with complaint. You know, one staff member said that Meredith told she would be hunted down if he ever talked about it. But here's the goofy part. The Senate Ethics Committee has recommended expelling Meredith from the Senate. But constitutional scholars waiting in say they may not have the power. They've never expelled a member in the past. They've suspended him. But they can't. According to University of Waterloo's constitutional expert Emmett McFarlane says, in quotes, the Constitution sets out tenure and a list of disqualifying factors for senators. Ethical breaches are not included. Doesn't that just say it all? Ethical breaches, not cause for expulsion to the Canadian Senate. The moral of the story? Lock up your daughters. Go out and have a terrific weekend. Join us every day on moneytalks.net.